Hello everyone, welcome to a new video on the basics of economics, which I'm going to talk about banks and how they work and how they influence the economy. So what I'm going to talk about specifically is just the basics of banks, which are just deposits and loans and how interest rate influence the way people behave. Then I'm going to talk about liquidity and why it is important, specifically in the context of crisis. Then I'm going to talk about other departments. So I'm going to go into a bit more detail about banks and how they work by just highlighting some stuff that you might not know or you might not have been aware of. And then I'm going to talk about what regulations are important for banks, how they work. And lastly, I'm going to talk about why trust is so important for banks. So let's just talk about deposit and loans. So this is just the basics that most likely people already are familiar with. But I just want to make sure that everyone knows what we're talking about. And I want to talk about interest rate and how this affects people's behavior. So deposits are just when you have an account with a bank and then you put money on the account. When this is a checking account, this just basically means that you can use the account to pay for stuff. So you go to the grocery store, you are buying something with your bank card, and then the bank transfers money from that account towards the grocery shop's account, and then everything is fine. You could also use this account to basically get cash money from an ATM. You just use your bank card, and then you get cash on hand. There's also another thing that you can do, which is called a savings account. And the idea is that you keep your money there for a long time, and then every year the bank gives you an interest rate over that money. So the idea is that you just keep that money there, and then you just get a specific percentage that the bank pays you. Another thing that banks do is just they loan out money. So you ask just money upfront, and then the bank gives you that money, and then you need to pay that money back plus a little bit of interest rate, which is a specific percentage that you need to pay back. So this can be for either a mortgage or a car loan or a student loan. You need to pay that back plus a little bit extra. Why do you need to pay those interest rates? I think for two reasons. The first thing is it might be the case that there are just other people who also loan money, but who are unable to pay it back. So therefore, because the bank is taking a risk there, they need to get the money from other people to then, recuperate the loss that they had from loaning to someone who was unable to actually pay back the loan. Another thing is just banks want to make money. It is very profitable, so therefore they just, make you pay more because you just, pay for that convenience. So that's the reason why you have an interest rate over loans. Okay, how do then interest rate influence the economy? At the moment, you have higher interest rates. This means that the amount of money that you get in a savings account just increases every year. So it is more likely that you as an individual would want to put it in a savings account. On the other side, it also becomes more expensive for you to loan money because you need to pay more money over the loan. Therefore, it is just this is a way in which interest rate from banks influence how people behave. So if there is a crisis, what you want to do is you want to lower the interest rates because that means that people can loan more easily. They are more likely to spend stuff in the economy because it's not that good to keep it into a savings account, which is good because this then creates more jobs for people, and therefore you're able to get out of the crisis. Um, and at some point, you also need to put the interest rates up again because at some point, you can't go from 0.01 interest rate to 0.0001%. That just doesn't influence people. So there needs to be a difference. So at some point, you need to go from maybe the 1% interest rate that you had to then go again to 2 or 3% so that you're able to lower it again in times of crisis. This is something that you just should do when, the economy is going well because that people can take that hit. They can pay that extra money. It's not that bad for the economy. So this is the way how interest rates then influence the economy, just from the basic principles of deposits and loans, and then just you spend more in the economy or you spend less, depending on if you have more money or if you have less money. Now, let's just talk about liquidity, because I talked to you about the savings account, but the savings accounts are there for a reason. The idea is just that banks are able to use that money, for example, from the savings accounts or from other accounts, to then loan that money out towards other people. And the idea is that if this happens well and they pick the right candidates, then people will pay that back, and then the bank just pays more money because people need to pay interest rate over those loans. That is the idea. But as you know, sometimes people are unable to pay back their loans. Maybe the company fails, and Therefore, you don't want the banks to loan out way too much money. Therefore, there is a liquidity standard, which is basically saying how much cash do you have on hand. Because if I have a bank account, I want to be able to go to the ATM and then get my cash money out. But if the bank then doesn't actually have any cash anymore, it's basically unable to, help me get the money. This is something that the bank kind of like promised me to do. So it's really bad and looks really bad for the bank if they're unable to give me my cash or if they're unable to actually make a transaction happen. And therefore, it is overall just a requirement that you want to do. Now, there's of course a nuance here, right? Because if you put a really high liquidity, so you require a lot of money to be on hand for banks, this means that you have less economic activity, right? Because you're going to have less money being loaned out, and because less money is being loaned out, less businesses start, less jobs are being created, and therefore those people who now have suddenly money because they have a job are also unable to spend that money in the economy if their job doesn't exist. On the other hand, you don't want it to be too low because that means that banks might give over loan or like give too much money away. And then when a crisis hits, they don't have the money that people need. So you need to find a balance there. And this is oftentimes the percentage for banks is somewhere around the 10 to 20% margin. So if I have a bank account there with $100,000 in it, then that should mean that the bank should have something like $10,000 to $20,000 for me on cash ready so that I can withdraw it, for example. Now, this is just with cash money and being able to transfer money to accounts. But there's another thing that's important, which is called market liquidity, which is a bit more difficult to understand. But the idea is just that banks don't just have cash. They also have other stuff that they own. So they might, for example, own gold as reserves, or they might own land or stocks or anything else. And these things are nice, but there's also a liquidity here. But it's a bit difficult to say like, you just have these kind of stocks or these valued houses, therefore you have liquidity, because it's not something that I can, immediately transfer towards money. So what is then used is not just called this word liquidity, but specifically market liquidity. And it is based on two things. First, to what extent does the product have a clear price? And to what extent can you easily sell it? So let me just give you an example here. Let's say you have gold. Gold tends to have relatively stable prices over time. So therefore, you know that the price will be quite clear and you kind of like know what people are willing to pay for it. So it has a clear price. But also there tends to be a high demand for gold, either because people want to make jewelry from it or because it's seen as a quite stable investment that later on will be valuable more and therefore people want to buy it. So this is something that's also more easy to sell. Therefore, it is a good thing to own because, or like it has a higher market liquidity because it's just easy to see what the price is that you have and that you can get for, and it's easy to sell off, which is why it's good for the banks to then have this. If you have something else where the product doesn't really have a clear price, so this might be new paintings, like modernist paintings, you don't know how much that's going to sell on the market. So as a bank, it isn't really nice to have that as a reserve because it doesn't really have a clear price. Another problem is just if you have a great difficulty selling the product. So if you have, for example, a cryptocurrency and use a bank buy that cryptocurrency, if only 3 other people buy into that cryptocurrency, it's very hard to sell the product because you don't know if any of these 3 people want to buy it at some point. So it's just very hard to sell, which means that also this cryptocurrency has a low market liquidity. So when we're talking about liquidity of banks and making sure that they are stable, this is not just about the amount of money that they have, but also what do their reserves look like? Do they have just a lot of houses? Do they have a lot of like land? Do they have gold? What kind of reserves should they have so that when they have a crisis, we are sure that we can sell off those things and that we are able to then, use that cash to then, invest or to buy back the loans that we had, or like, it's not that bad when people are defaulting on the loans because we still have extra money from these things that have increased in value, such as gold. So what are then other departments that just, deposit and loans that we've talked about? I'm going to talk about 3 of them. The first thing is just investment banking. So this can be either for clients who have an investment account. So this can be a person or a very rich person or like a company who might have an investment account at a specific bank. So they say, here's $100,000. You, big bank, just invest it for me and make a profit. And then the bank, takes a bit of the money that they, a bit of money. They ask for a specific fee that you pay every month so that they're able to, facilitate investing for you. Sometimes they do it also for themselves to just, make some profit. What they also do, banks, is just raise capital. What does that basically mean? So they create and analyze what's called capital or stocks and these kinds of things. So what it's going to look like is, let's say you have a company, and a company can have stocks. And the idea for stocks is that you own a part of the company. And if you own a specific percentage of the company, then you get specific rights. So it might be that if you have a specific stock, then every year they pay you out a specific amount of money dependent on the profit that they've made. Or if you have at least 25% of stock, then you can be in the board of directors, which makes all these choices in these companies of the stuff. But these stocks need to be created, right? You need to make sure that, you need to somehow create them. And banks can help here by creating what's called an initial public offering, which just means that at some point the company just, becomes public, means that they're going to sell this stock that we're talking about, this percentage of the company, which either pays back in money or in power that you get over the company. But this needs to be done by someone, and it's basically the bank who tries to do it. But also what they can do is they can have services in which they analyze companies for you, or they analyze markets. So they have these really smart people and these really big computers which just analyze markets, and then you can buy that information, or you can request a specific thing to be researched, and they do that for you. What they also do is they just help with mergers and acquisitions. So if two companies really like each other, then what might happen is they want to become one big company, and then you need to make sure that everything goes correctly, right? So the account become merged, that you make sure that you know who's going to stay in what powers, the exact structure you're going to have. How are you going to do this with stocks, for example? So the percentages of the company that people now own. And this is also facilitated by banks. And lastly, it also facilitates trade. So there are two ways that this can happen. I think the first one is just intuitive. I want to make an transfer from the Netherlands to Bulgaria to pay for a specific tournament, then the bank can just transfer that money, and this facilitates some form of trade. They get my money, I get their competition. Another thing that the banks do is they can create what are called bank guarantees or letter of trusts. So this is just relatively intuitive if you understand how trade works. So I want to buy, for example, bananas from Brazil. The company needs to know that I'm actually going to pay for it, or that I have enough money to pay for, I don't know, 1 million bananas. So then the bank, what they can do is they can give a guarantee that even if the person does not give them the money for 1 billion bananas, then the bank will give it to them. So there's a guarantee there. So therefore, the exporter is more likely to actually want to trade with me. But on the other side, I don't know if those, bananas are actually going to, be sent to me or shipped to me. So what then the bank can do is create a letter of trust, which then shows, ah, uh, they have done in past performances really well. They've always delivered, so we know that they are trustworthy. Or what they can do is, we're only going to take the money away from those billion bananas when we have documented proof that ships with bananas have left this port in Brazil. And here's also why this is important for banks to kind of be trusted, because they are in all these things. There is a level of trust that people need to have with banks to engage them in the first place. And I think it's important to already highlight that the banks sector is just very diverse. So you have banks which only focus on just deposits and loans, um, and don't really do that much in the form of raising capital or facilitating trade. And this can be especially true if this is maybe more smaller or a regional bank. There are banks who are only for investment banking or are only for raising capital. So it isn't the case that every single bank does all of these things. There are different niches that different banks have and different groups that they cater for. Um, and this also is important to kind of like understand when we're talking about regulation and what kind of banks we are talking about when we're talking about international trade, or when we're talking about interest rates and all these stuff, to understand that this affects some part of the banking sector but not directly other parts of the banking sector. So the interest rate only matters if it's a bank that just has, deposits and loans that they give out. But it isn't important necessarily for investment banking because their fees are just determined on, you know, how smart people are or how much money that they make from those accounts. So it doesn't really matter for them, nor does it directly matter for facilitating trade or raising capital. So when we're talking about banks, being able to understand that there are different banks and that they interact differently with stuff is important because this means that you can outframe, other people by just talking about different banks and explaining why they might be the most important thing in explaining how the economy is actually hurt. Now let's then talk about regulations. So overall, the idea is that you have a bank which has quite a lot of power and a lot of information that they uniquely have. And this unique position should not be used for their own like help and to screw over other people. So let's just talk about the ways that we have regulation for this. So you want to make sure that the banks have different sections which don't engage with each other. So you want to keep, for example, the investment banking groups separate because if they know that, for example, a big company like Microsoft wants to sell off a lot of stuff, like a lot of stock, then that means that if there's another management account who has also the same thing that Microsoft wants to sell off, if they know about this, then they know before everyone else knows that Microsoft is going to use to sell this off. So they might also try to sell off the stock of the company that Microsoft is going to, sell off. And that is just not fair to people who are not inside the bank. So it's just something that, you don't want to have these investment groups have more information than everyone else because it's not fair, but also just creates perverse incentives where they can just be like, oh, we're all going to massively sell this off. We're going to make a huge profit. Or we're going to buy low for one product, then buy a shit ton of that product. And everybody thinks that there's suddenly a really high demand. So people really want to buy the product, and then we're going to sell off those products, such as like stock, to then make more money. And then this is just called market manipulation. So this is not something you want to do. So that's why you want to have different investment groups being separate, but also investment groups being away from, deposit side, from the merger and acquisition side and the stuff, because you just don't want to have them share the information. They're just like these Chinese walls between these groups, which is why they are called this way. Another thing is fund runs is just where is the idea that the bank might have like stocks in, let's just say, Apple, and then they know someone else is going to massively sell them off. Then they know that there's going to be less demand for Apple stock. So then they know, we might want to sell our stock first because otherwise, the price of our stock will devalue and we don't want that. So we want to sell our stuff first. So it's somewhat similar as the first one, but specifically about their profit. So just that they're able to manipulate the market so they themselves can make money instead of, other investment groups in the bank making money before other groups in the investment banking or outside of their specific bank. So now I already talked a bit about trust, but I just want to make this clear. So trust is very important, and this perception of trust is important for if I want to put my money there, if I want to invest, for example, in these investment banks, if I want to give them my money, but also if I would want to even loan from the place or want to put my deposit in. So trust is important because you can get stuff if you don't have this, which are called bank runs, which is where if I believe that a bank will go down and I won't have access to my money, the first thing I'll do is I'll go to the ATM and withdraw as much cash as I can. So I at least have some money. So I'm sure I have that money cash. But if I do this, then other people might feel like, people are going to ask for a lot of cash, so I should also do the same. And everyone then goes for that cash and tries to cash out, which means that the bank is basically screwed over because, as we shown with liquidity, they don't have all that cash on hand, which means that some people will just not get their cash. So you want to make sure that people just don't do this bank run and they don't just ask for all their money back from the bank. What also might just happen is you just don't invest in these companies. So again, if the banks make money from you paying a fee for them to invest your money, but then you're not, paying the fee because you're not having an investment account with them anymore, then the bank is just not making as much money. So this is why it's important to create trust for these banks, so you don't have a shock, right? Because if now the bank has suddenly no money cash because everyone basically drew it out and they're unable to pay others. If people just don't want to invest them anymore, then basically they don't have any profit and they're basically going bankrupt. And this is problematic because this means that people just lose their money. So suddenly people who had a savings account or a checking account now can't have access to the money because the bank's unable to give to them, and the bank cannot exist anymore. Like, it's gone bankrupt. So they can't facilitate what they used to do before, which is again these deposits, but it's also these mergers and acquisitions. It's also these investments they've been doing in the economy. It's also facilitating this trade between nations and making sure that exports can happen. So this is why it's important, because it impacts every sector of the economy, and therefore it is important for banks to actually have this trust. And it's also why you want to have regulations, because at the moment you have good regulations, people feel like these banks can be trusted, that they are fair, that they're not going to collapse, that their liquidity is high enough, that they have enough reserves, all of this stuff, which means that they, are willing to invest in them, which is why you have these regulations in the first place. So I hope this all makes sense. And a way to make sure that you understand what is talked about within this workshop is just asking yourself largely these three questions. So just ask yourself, what do banks do? And how do they differ? How do they interact? What is liquidity and why does it matter? And lastly, like, what kinds of regulations are put in place for banks and why are they necessary? Why is it necessary to create trust? And if you are able to answer these questions, I think you understand most of the things that we talked about in this video. And if you wanna then test your skills, then you can also just maybe start analyzing this motion, which is this house will nationalize all banks. And then you can maybe make a gov case or a up case and try to use the information that I've given you in this video. Okay, I hope that this was clear. If you have any questions about something that I said or something that I explained, then you can put it in the comments. I will try to make, either respond to the comments or I will make a video detailing what you are asking about. And then the next video will be on central banks and how they influence the economy. Okay, cheers, see you in the next video.